we may want to structure that one in a trust instead, so that you're able to access that 50% discount. What are the long-term ones? Long-term solutions, and I've got in brackets on this slide, and permanent solutions as well. So avoiding Division 7A altogether. It is possible. There's potential drawbacks though, because again, we're not getting access to that cash personally, but that may be okay depending on your circumstances. So first one we've got here is actually pay the cash into the company. So just pay the cash back, and you're repaying the loan. But the downside or the drawback is this may be a poor use of funds. Now keep that in mind. That might be step one to combine with one of these other solutions down here. So another option is to pay the top-up tax. It is expensive. So what I mean here is if you've already paid 26% tax in the company name, and you want to get access to that cash permanently, then you can issue dividends or salary, depending on your structure, to the individuals in the family group. You may be taxed up to 47% on that, and we call that the top-up tax of 21%. Now, again, we can work that out, what that cost for you is to clear the Division 7A loan account, but it may be an expensive way to do it. And usually, again, there's potentially better solutions to work around that. The next one here is buying shares or managed funds in a bucket company. So I've got the word bucket company here because we wouldn't want to buy shares in a trading entity. The trading entity, because if you're in business, it is attracting risk in your entity. So from a asset protection perspective, we don't want to create an asset to potentially lose if something were to go wrong in the business. But again, we can bolt on a bucket company to one of your structures so that we can take the dividends out of your trading entity, put it in a bucket company, and then buy shares or manage funds in there. So again, there's a way to do it, but we just don't want to buy shares or manage funds in a bucket company. In a trading entity. Also, if you do buy shares or manage funds in a company, you do not get access to the 50% capital gains tax discount if you own those shares or manage funds or assets, anything, property, whatever, for more than 12 months. So in your own name or in a trust's name, you do get that 50% discount, but in a company you do not. Now, the whole reason why I'm suggesting shares and managed funds and not property, is because shares and managed funds often have an income component to them, and your tax rate on that is 26%. Or if it's a purely investment company, you'll be paying 30% tax on your dividends and trust distributions from the managed funds or shares. So in terms of property, there's if you do want to buy property and use company money for that, we might look at option 4 for that. And just jumping back to shares or managed funds, if you've got the choice, then the preference would be to invest in income-focused shares and managed funds in the bucket company. And if you've got capital growth assets, like, again, you can buy, let's take index funds. There's certain index funds that the goal is to produce an income stream. And then there's index funds where the goal is to grow in capital, but not pay anywhere near as much income along the way. Then that is the one, because your priority in that case is a capital gain. We may want to structure that one in a trust instead, so that you're able to access that 50% discount if you were to sell that that index fund or managed fund. So again, the income focused is the priority for the bucket company. Again, we're getting really detailed into there. And this is where a conversation with the accountant would go really well to just work out, look, are we jumping at shadows, splitting it this much? Or some people's investment strategies actually require that sort of detailed planning